So I'm excited to announce the next guest speaker, Dr. Marc Garmaise. He is from UCLA and he's an associate professor of finance. His expertise is in corporate finance, real estate, entrepreneurship, and banking. Currently, he teaches courses at UCLA of venture capital and private equity. Prior to joining UCLA, he was with the University of Chicago, also teaching finance. He has a PhD from Stanford University, and he's a really smart guy. I'll tell you a story about him. Is I recently got back from a trip from Japan with him. He and I and a group of researchers went in to consult with several of the Fortune 200 companies of Japan, including Toyota, Toyota, Canon, the Bank of Japan, the Ministry of Information Technology, and it really frustrated me being on the team with him because he is so smart. Everybody wanted to talk to him and not the rest of us. So with no further ado, Dr. Garmaise.
Thank you, Marc, for the invitation. It's lovely to be here. Today I'm going to be talking about mortgage brokers and banks. So I'm a finance guy, as Marc said, and I'm going to mainly be talking about a finance topic. Towards the end, I'll try to bring it around to some broader business issues as well. All right, so this is obviously an important question. How do we get into the current credit crisis? And one big contributing factor was failures in the residential mortgage market. So this is very well known. And I'm going to be focusing just on one specific aspect of the origination process, the way in which new residential mortgages are created, and that's the relationship between mortgage brokers and banks. Okay, so mortgage brokers, probably all of you or many of you have worked with them. They're specialists who help to bring these mortgages to banks, and I'm going to talk about how those relationships evolved over time. Okay, so the sort of big picture here is that relationships overall got a lot worse over time. Okay, so you might think that perhaps relationships should build trust and things should get better over time, but my sort of big picture take-home message is actually a lot of the delinquencies that we see were purely attributable to worsening relationships over time between mortgage brokers and banks. Okay, so a little bit of background here. What caused the residential mortgage crisis? How did we get into this mess? Here are some potential contributing factors. One is securitization. So this was the process in which the banks made mortgages and then sold them off to Wall Street. And it was sometimes argued that the Wall Street investors weren't paying attention, the banks weren't paying attention since they didn't have to hold on to the mortgages. Securitization perhaps was one of the culprits. A second potential issue was lending standards just got lax. Banks stopped being as careful as they used to be. A third criticism is the role of the ratings agencies. So why did Wall Street investors buy these packages of mortgages? Well, because they were rated by ratings agencies like Standard & Poor's, Moody's, etc. The ratings agencies fell asleep at the switch. That's what caused the mortgage crisis. And a fourth potential factor is just special problems in the subprime lending sector. Okay, for whatever reason, maybe it was over-subsidized, maybe credit was extended there inappropriately. Really, it was the subprime lending sector that caused the crisis. I think that there's something to each of these four stories. I think they're all important stories, but I'm not going to talk about any of them today. Okay, so just to make clear what my focus is, I'm only going to be talking today about mortgage brokers. And it's an empirical study. It's based on a study of actual data at a bank that had relationships with mortgage brokers. And this bank did not securitize its loans. So it did not take the batches of loans and sell them off to other investors. It kept them all. Okay, so it wasn't a securitization problem. Didn't have anything to do with ratings agencies. Rating agencies were not evaluating the loans that this bank made. And moreover, it's not a subprime story. This bank actually tended to make loans to pretty high quality borrowers. Okay, so my story is just about mortgage brokers and banks. All right, as I mentioned, I think there are two reasonable ideas, two sort of models that you might have in mind for what happens in a relationship over time. The first model is people build trust. Right? You get to know your business partners, And over time, a deep reservoir of trust builds, and people behave better even when their partner isn't looking. Okay, so that's model number one. Trust improves over the course of a relationship. The second model is the opposite, namely, at the beginning of a relationship, you're on your best behavior. You're very, very careful to set out a positive impression. And once you've kind of got the relationship going and settled any doubts on the part of the other party, you start to chisel a little bit and to behave a little bit less well over time. Okay, so the second model is actually behavior in relationships gets worse over time. And today I'm going to be presenting research really in support of the second story. I think they're both reasonable ideas for what might happen in relationships and how trust evolves, but almost all the evidence I'm going to present today is in favor of this second story. Okay, so why is it? Why would you bother? Why is it that trust decreases over time? Well, just for the reason that I gave you. It's really important at the beginning of a relationship to establish your bona fides, to show the other party that you behave in good faith, but once that trust is established, the other party's monitoring you much less carefully, now you can cut some corners. Okay, so this is research based on actual data, about 24,000 loans that were originated from 2004 to 2008. As I mentioned, the bank did not sell these loans to Wall Street. They kept the loans, so the bank had every interest in making sure that they were accounting for risk properly. These were floating rate loans, so these are sort of adjustable rate mortgages, and they were risky. So many of them allowed for negative amortization. So what does that mean? It means that the required payments were pretty low. If you wanted to, you could make a pretty low payment every month, even less than the interest rate on the mortgage. What happened to the difference? Well, that difference was added to your balance. So you might have started out borrowing $100,000, say, from the bank, but over time that could increase to $105,000, $110,000. You were making these small initial payments, and then after a certain period of time, the balance would become due. Okay, so these in some sense were quite risky loans. The interest rate was shifting over time, and you could make small payments up front. This bank basically didn't get any of its mortgages itself. They relied on a network of suppliers, mortgage brokers, to provide them with all their product, okay? And there were a lot of them. So there are about almost 3,000 mortgage brokers with whom they worked. Most of them sent in not that many deals. So most of the mortgage brokers sent in, say, 10 to 15 deals. And then there's a small number of mortgage brokers who did a lot of volume with the bank. Okay, so a variety of suppliers of mortgages and different sizes, some small, some big. Okay, what I'm going to be doing is looking at an objective measure of mortgage quality, namely, did this loan default? Okay, so the bank didn't know that at the time, but I'm able to track the mortgages over time. So I'm going to look at this measure that's revealed over time. Did this loan eventually go into delinquency? And I'm going to relate it to where we are in the relationship between the mortgage broker and the bank. Is this the first loan that the mortgage broker brings to the bank, or is it the 15th, the 17th? And how do things evolve over time? Okay. All right, so here's a picture of the delinquency rates that this bank experienced for loans originated in different months. Okay, so for example, in early 2004, of the loans that they originated in early 2004, about 2% of these eventually became delinquent. That's the historical US average. Okay, so when you talk to people, before the last couple of years, and you said, well, could there be a mortgage blow up in the United States? They would say, no way. Mortgage delinquency rates have never gone above 1 or 2% in the US. Even if you go back 50, 60 years, you've never seen delinquency rates go above 1 or 2%. Okay, that was true, in fact. And that was true for this bank at the beginning of the period. So the beginning of 2004. Now what you see is later on, the loans that they were originating in 2005, about a quarter of these loans eventually ended up becoming delinquent. Okay, so very dramatic effect, very strong increase in delinquency. What's happening over here? Why does the delinquency rate come down? Did the bank suddenly start making great mortgages?
No loans.
Oh, these are percentages. Yeah, so these are all, yeah, could be. They got a little bit better, but my guess is I just don't have enough time to see these loans blow up, right? So if I'm looking at a loan made in 2005, there's quite a bit of time for it to blow up. I only had data till about the middle of 2009, so any loans made here, my guess is they'll eventually blow up, but I just don't see it yet. Okay. All right. So so I think it's an interesting graph. I can't say. It's an interesting graph and quite striking, but this is exactly what my research is not about. Okay. So in other words, there's a very strong pattern here in the data. When I tell you I see relationship effects, I'm comparing loans made early in a relationship to those made late in a relationship, you might say, well, obviously, right? The loans made early in the relationship were made in the good times, 2004, and then maybe later in the relationship or in 2005. Of course the loans made later in the relationship are worse. That's not what my paper's about. Okay, so my research controls for the month in which the loan was originated. I'm always contrasting two loans made at the same time. Okay, two loans both made in January 2005, two different brokers, one in which the loan was late in a relationship, so this broker had been making loans for a while, one in which it's early in the relationship, maybe the first loan brought by this broker. Okay, so 2 points. First, there are very strong patterns over time. These are called vintage effects. Okay, so when the loan was originated really has a big impact on the probability that it goes delinquent. But number two, I'm controlling for that. Okay, so when I tell you I'm comparing late and early in a relationship, that's always for two loans originated at exactly the same time. Okay, all right, so what do I find? Well, as I mentioned, I find that loans made later in the relationship are much more likely to foreclose, to become seriously delinquent. Okay, and the effects are big. Okay, so roughly a fifth, say a fifth to 28% of the total delinquency risk that I find is arising just from the difference between the first loan that a broker makes and one in the middle of the relationship. They get dramatically worse. The quality of the loans gets dramatically worse over the course of the relationship, controlling for when it is that the loan was actually made. All right, so what's the key measure of the length of the relationship? Is it the number of months that the bank and the broker have been working together, or is it the number of deals that they've done together? And the answer is all that matters is the number of deals. Okay, so early on, meaning first 5 deals that the banks and the brokers do together, the brokers are bringing very good quality loans to the bank. After that, the loans start to get worse in a way that the bank doesn't see. It's not that these are obviously worse borrowers. The bank doesn't pick it up. The credit scores look the same, the riskiness of the loans look the same, but I know because I can look 4 or 5 years later that in some unobserved way, the brokers are bringing worse deals to the bank. Okay. Now, what else is this related to? I find it's related to the rate of deal flow, the number of deals that the brokers bringing to the bank. So what happens in the relationship is, first the broker brings a very slow rate of deals, 1 deal a month, let's say. And over time, as the relationship progresses, the broker brings many, many more deals, a much quicker rate, 10, 15, 20 per month. Okay, so what's happening over time is, number one, the deals are getting worse. Number two, many more deals are getting presented. All right, so what might be going on? One potential explanation is it's hard to come up with great deals, but you have to do that if you're a broker at the beginning of a relationship. It's very important for establishing your credibility. Once your credibility is established, well, now you just want to generate more deals, make more commissions. Now you're less picky, and the average deal quality goes down. Okay. Now, that's the broker side of the story. So the brokers are bring in worse deals. What about the bank? What does the bank do? Does the bank figure this out? So does the bank charge differently? Do they charge higher rates as the relationship progresses? Okay, so what do I find? I don't find that the bank charges higher rates. Okay? So the bank is not charging higher rates later in the relationship. The bank does seem to do a better job of evaluating the risk of the loans. So it figures out, relatively which are better or which are worse later in a relationship, but they don't realize that the overall quality, or at least they're not pricing the loans in a way that shows that the overall quality is diminishing dramatically over time. Okay. What about just firing the brokers? So this bank did fire brokers. Do they get more willing to fire brokers over time? So do they realize that the quality is going down? Maybe they should be quicker to fire brokers. Actually, I find exactly the opposite. That if a broker's been with a bank for a couple of deals and a mistake happens, there's a good chance that that broker will be fired. On the other hand, if the broker's been with the bank for a long time and a lot of mistakes happen, the bank is much less willing to fire that broker. So I actually said to the bank, what's going on here? And their story was, oh, that's interesting. We had the other model in mind. Right, so we thought it was model number one, that over time, we would build trust, we get to know these brokers. The brokers with whom we're just starting a relationship, they could be some fly-by-night operators. We've got to scrutinize them very carefully. Once we've got a very well-established, close relationship with the broker, we worry less about quality control. That turned out not to be the right model here. Okay, so I've spoken today only about mortgage brokers and banks. It's a narrow topic, though I think one that's quite important given the scope of the mortgage crisis. But it also has a lot of nice features, okay? So there are a lot of loans here. I see a lot of relationships. I really know the risk of these loans. I know how much people are borrowing, their credit scores. And the truth is, these are all fairly similar deals, right? They're all mortgages on houses. But I think the lessons here apply more broadly. So here I gave some finance examples because I'm a finance guy, but I would say even more broadly than that, I think that this study has something to say about relationships between firms and suppliers, relationships between firms and customers, and how they progress over time. Many of us have in mind model number one, that a long-standing relationship builds trust and leads to better behavior, better unobserved behavior. I guess I want to suggest that at least this piece of evidence indicates that the opposite can often be true, that there's a strong motive to engage in chiseling and worse behavior later in a relationship. What's the implication? The implication is just because you have a long, deep relationship with a supplier, don't take your eye off the ball. And I think that's sort of what this bank did, and they ended up paying for it. Okay, that's all I got. Great. Yes?
Creative destruction, is that kind of the theme? If I have a supplier that I'm working with, should I blow him up every once in a while?
Okay, very good. Well, you took my ideas to their logical conclusion. I didn't want to be quite that strong. I just said scrutinize them. Maybe if these long-term relationships had been better scrutinized, you wouldn't have to blow them up. But I would say you do have to worry much more about them than you might think. Good. Yes. Yes, sir.
Yes, given the popularity of 15-year fixed mortgages, do you feel in the long run that's going to help or hurt the mortgage industry?
Well, I'm not sure. I think they're much less risky. So in that sense, they're appealing to consumers, but they're more expensive. So it's we're paying for a form of insurance. The truth is, given the experience of the last couple of years, we're probably all in a mood to pay for that kind of insurance, so it may make sense. My guess is we'll see a move back to cheaper, more flexible forms of financing, but maybe not until we all feel a little bit less nervous. Fixed rate mortgages are expensive. Most other countries in the world don't have 30-year fixed rate mortgages.
That's true, yes.
That's very unusual. So right now is not a time for people to stand up and advocate for financial flexibility and risk, but my guess is, say 5 years from now, we'll see a switch back to at least some forms of adjustable rate mortgages.
In your study, it sounded like there were a smaller number of larger originators, right?
Yes, there were.
What was the evidence there of their quality versus the many small brokers?
Yeah, so for every broker, I looked relative to the nature of that broker's own relationship. So if the broker had done 50 loans, I compared, say, the first 25 to the second 25. If they only did 10 loans, I compared the first 5 to the second 5. I didn't find any effects about big brokers versus little brokers. All the effects were early in the relationship, late in the relationship. Yeah. Yes?
Do you think your results would be different if you had studied fixed rate mortgages?
Keep going. Why might that be?
Because they might have a lesser propensity to failure.
Okay. So, very good question. So, I think that, let's suppose I'd done this study 10 years ago. What would I have found? Basically nothing. And the reason is that there was hardly any delinquency rates. So, I think that you're right. So, if I'd done it with fixed rate mortgages without negative amortization, I would have seen less, just because there was less action, right? So, the reason that this is a good data set for my purposes is there are a lot of delinquencies here. Whereas 10 years ago, or fixed rate mortgages, there are fewer delinquencies, hard to see the decline in quality. So, could be. My guess, or maybe related to your question, is would I have seen a different result if the brokers, instead of getting a fixed compensation, had some kind of trail or some fee that depended on the eventual outcome? Yeah, I would guess that might have affected their incentives.
And one more. What if the bank had actually sold the loans?
Right.
Would that have made any difference in your results?
Well, I think that people would have expected to see something like this more had the bank sold their loans, because they would have said the bank doesn't care, right? So the bank doesn't monitor the brokers because the bank doesn't care. But here the bank really hasn't cared, yeah, and still they seem to not get it right. So probably would have been worse, yeah. Yes?
So it appears you compared the broker to itself with this first 25, second
Yeah.
25, first half, second half. Did you do any intra-broker comparisons where 20% of them didn't do bad loans at all? 20% did a majority of the bad loans within the sample set?
There are differences, certainly, between brokers. It's not quite as stark as you're describing. So there are, absolutely, there are better and worse classes of brokers, but I wasn't able to figure out ex ante what made a broker good or bad. So I could look afterwards and see, oh, really, there is a spread. But there was no characteristic that, enabled me to kind of stamp a seal of disapproval.
It was like a bell curve.
There was, but there was nothing that said to me they should have been suspicious of that broker. So I guess the only piece of evidence that I had is I found that the decline in quality was worse for brokers who were located further from the bank. So there the story might be they're less worried about their relationship with the bank, because if it blows up, they have their own local banks to deal with. That was really the only characteristic that I found was correlated with the average broker quality. Yes?
How could the consumer be protected?
Well, it's a funny question, because here, in some sense, the consumers like getting loans approved. I mean, unless we take the view that the consumers were probably, maybe the consumers didn't know what they were getting into, and they ended up investing money that got lost in a house. But my first thought would be consumers like getting loans approved. I'm not sure that consumers ended up really disadvantaged. I mean, I'm clear that the bank ended up paying a huge price. Maybe if you tell a story about consumers going to mortgage brokers and saying, should I get into this loan? Maybe you worry that the first loan that you do with the mortgage broker, they'll be very careful and they'll give you great service. But after refinance number 7, maybe they're less careful.
The topic is interesting because we were refinancing an office building, and my wife and I just said something is wrong.
Oh.
And we just made a very difficult decision, but we intuitively just felt that this is structure numbers this way, the structure that way, then a package. We just said, what is going on? In fact, my wife said to me at one point, hand to God, I'm not going to look good in an orange suit, Walter. Or a jumpsuit, it's usually. And shortly after that, we made an executive decision.
Was it being structured by a broker, or
what?
Was the refi structured by a broker, or?
Yeah.
Okay.
No, first time we ever felt that way.
Oh, yes.
I mean, the broker just syndicates the deal to the funding source.
Pardon me?
Well, it seems like it could go either way. It could be either the you know, over the relationship keeps going on, gets longer and longer. Well, the broker is just syndicating, selling the mortgage to the bank. And it could be, like you're saying, the broker is selling worse deals to the bank, or the bank is almost not doing its credit check as much and trusting the broker and just taking the deals without doing their research as much as the time goes on. So it couldn't, you know, the broker's saying, great, I got all these deals, I'm selling all these deals, and the bank keeps buying them and buying them, great. But the bank's responsibility is to do the credit check, right?
Oh, yeah, I mean, the bank doesn't look good here.
Oh, okay. And the broker, and the guy keeps buying the deals,
Yeah.
even though I put down their, you know, their assets are this is that, blah, blah, blah.
Yeah.
And the bank says, great, I'll just keep buying these deals. Well, as a broker, I can't say, hey, I just sold this deal, you shouldn't buy this deal from me.
You know, well, there was some talk about, you know, values in business earlier. That's maybe not I do finance, so I don't know a lot about values, but you know, I think there is an argument that the broker should not be forwarding mortgages that are.
Well, I mean, a broker, they're not very, you know, their responsibility is to get the deal funded for their customer and have the bank who's buying it says, hey, I did all my research on the credit, your assets and everything, so I approve it.
You know, it's not a quantitative measure in which these mortgages are getting worse. So all the credit scores and loan-to-value ratios, income assets, I don't see any patterns there. There's something unobserved that I actually think brokers know that the banks just don't get to see.
I'm not a broker.
I see the hands up. We're actually going to have an opportunity to ask you more questions on the panel section in a few. So can we give a thank you to Dr. Garr?